Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Happy Tuesday, everyone. Let's get to the three things that you need to know today.
First up, U.S. stock futures higher today following a risk-on rally for stocks that sparked back-to-back gains in the S&P 500. Investors assessing mixed messaging on tariffs from the White House, with the president pledging levies on cars in the coming days, while indicating nations will receive breaks from next week's reciprocal duties.
Plus, rate cuts front and center for investors. Amid tariff hikes, as Atlanta Fed President Raphael Bostic said, he now sees just one interest rate cut as likely this year rather than two, amid the White House's trade plans. Now, investors will get the latest read on the economy today with Conference Board consumer confidence that's coming out.
And Tesla shares rising despite the news that the EV maker's sales in Europe plunged 40% in February. The company's sales have dropped in the region in 10 of the last 12 months. Now, after that, we have one investor remaining bullish. Cathie Wood's ARK Investment Management expecting Tesla stock to hit $2,600 in 5 years, almost 10 times its current price. Wood saying in an interview with Bloomberg that Tesla's robotaxis will account for 90% of its value over that time.
U.S. stock futures edging higher this morning after the major averages closed higher on Monday on hopes of President Trump taking a softer approach to tariffs. This comes as economic forecasters on Wall Street predict tariff policies will weigh on business activity this year. Yahoo Finance's Josh Schaefer is here with us now. Josh, is this recent bounce off of the lows of the markets due to the data not showing signs of a looming recession?
I think you could certainly argue that way, Brad, right? So what we sort of explored in my story that's on the website this morning essentially was, yes, economic data is slowing, and we've gone through this sort of re-rating of economic growth expectations from outperformance to perhaps maybe slightly below 2% GDP this year. But key within a lot of the calls we've been talking about among these economists is no one's really calling for a recession right now, right? And I think when you talk to strategists and sort of pin those 2 points together, that's maybe why you've seen a bottom in this drawdown that we saw, right? If you were seeing a pure risk-off recession trade, you might have seen stocks fall even further, right? A lot of strategists had sort of highlighted that 5,500 level on the S&P 500, essentially arguing if data were to worsen from here, then maybe we go below 5,500, and then maybe this isn't a buyable dip. But you're seeing a lot of strategists argue this probably is a buyable dip, or perhaps a tradable bounce off the bottom. And so I sort of started exploring this yesterday after we got S&P PMIs. Those came in, the composite came in better than expected. One of several data points that sort of lagged in January, then popped up a little bit in February. We're going to keep tracking that sort of data. And of course, you guys mentioned we had Conference Board consumer confidence coming out at 10 a.m. today. And there's definitely a difference right now between the vibes that consumers are talking about with the economy and what we're actually seeing within the data. Of course, not necessarily a new trend post-pandemic. We all remember using the word vibesession a lot, but it does feel like we're back in that sort of dynamic a little bit right now.
And we were talking too just about the confusion about whether or not the data is currently best suited to give us a sense of those vibes. One question I have for you, though, that I know you spoke with sources about is this idea of whether we are already slow or if we're in the process of slowing. What are your sources looking at?
Yeah, I mean, I definitely think most people would argue we're in the process of slowing to some extent. The question is, how much do we slow, right? I think the important part to point out was one of the economists I spoke with from Deutsche Bank, Brett Ryan, had sort of said, I thought consumer spending was going to slow to start the year anyway. That's agnostic of President Trump, that's agnostic of tariffs, and agnostic of a lot of those other aspects, right? Consumer spending was pretty hot to end last year. To have some give back there and come back to trend isn't necessarily surprising. Ryan was looking at something like continuing claims. Those come out every Thursday, right? So the amount of people that are continuously applying for unemployment benefits on a week-over-week basis. He said he would expect that number to tick up higher than it is right now if we were seeing a slowdown in the labor market. That number has sort of just been hovering at a 3-year high for several months now. So him sort of making the argument that until that number continues to move higher, or you see initial claims move higher and you get layoffs, then maybe the labor market's in an okay place right now. I think the question with both what just happened to the stock market and the economy is, if we're sort of on this thin ice of okay right now, what happens if we do get widespread tariffs, and how does that sort of impact the economy? And I think that brings you back to that tariff conversation and why we keep talking about it. I know you guys are going to talk about this in a minute, but if you were to get widespread tariffs, perhaps more than we're pricing in right now, maybe that does weigh on the growth outlook more. And again, you're at an economy right now with a pretty low hiring rate. The labor market is steady, but not necessarily in a firm spot that it was in 2 years ago. So when you're on a little bit of thinner ice and you start adding in some variables, that's where people start to get a little worried.
And the other major consideration too, even within that labor market, is where do wages moderate from here, and how does that play out more so in the mindset of the consumer?
Right, and because consumers need to spend, right? At the end of the day, that's sort of what we're talking about when it comes to the economy and why it matters to the stock market. Is we talk about these businesses make profits because we all go and spend money, right? Whether it be businesses spending money to other businesses or us going out and buying something from Walmart, they need us to be spending money in order for them to continue to grow profits. And that's sort of the ultimate looming question here, as always, is will the consumer keep spending?
Great golf shorts for $16 at Walmart. My
Really,
goodness.
Brad?
There you go.
Yeah.
All right, we're leaving with a pro tip today. I got to go check those out.
That's all I got for folks at home.
all
Life
you
hack,
got.
spending hack from Brad Smith.
There you
we
go.
go.
We love it. Thank you so much, Josh. Appreciate it as always. The impact of tariffs weighing on economic forecasts and leaving investors cautious ahead of earnings season. We spoke to Matt Orton, Raymond James Investment Management Chief Market Strategist, about his outlook.
I think the catalyst is going to be earnings season, because tariffs are not, I think the biggest uncertainty that investors face right now is what earnings growth is going to look like later this year and into 2026. So I think earnings season is going to bring the focus onto who the winners can be in this environment going forward, because not everyone's going to be able to win.
Joining us now, Stephanie Roth, Wolfe Research Chief Economist. Stephanie, great to have you in studio. You heard there Matt talking about how tariffs might show up in earnings, and we saw tariffs showing up in the data for the first time with that PMI data yesterday. To what extent are you weighing your outlook based on the tariff policy while we don't have certainty at this time?
Yeah, and the certainty in and of itself is a headwind on GDP, right? So base case is that we do get some significant tariff policy. If he goes reciprocal tariffs plus VAT plus sectoral tariffs, now we're talking about a 1.4 percentage point GDP headwind. We're not incorporating all of that. That would be really significant. And as we're starting to see today, there are some negotiations. So base case, you have reciprocal tariffs, which are actually not that big of a deal if they don't include VAT, and we can certainly get into that. Yeah. Sectoral tariffs, which he seems to be pretty committed to, although maybe the timing has been pushed back, which was some of the news over the weekend. Combination of all of that is about an 80 basis point headwind on growth. We're looking for 1.6% GDP this year. So it's about half of what we had last year, but we're still growing. Should still be an okay economy, although notably slower than where we've been.
Okay, so let's break down the significance of the VAT headwind there, which for folks who are just watching at home and trying to figure out, oh wait, we're bringing VATs back into the conversation once again. VATs essentially the value-added taxes here, but why does that matter in the reciprocal part of tariffs that could play out?
Because it's a very significant amount, right? So the VAT tax in Europe, for example, is about 22%. So if you all of a sudden add VAT plus reciprocal tariffs, the differentiation in our tariff versus Europe's tariff is about 3%. So either it would be 3% if we don't include VAT, or something like 25% if we do include VAT. By the way, it doesn't make sense necessarily to include VAT because they're treating US and foreign companies equally. It's not as if it's an unfair trade practice, but the administration seems to feel that way about it.
But how do you, I think it's a great example of the question of how do you model in this environment? Because you talked about in your notes to us that could be a 150 basis point hit to GDP. That's pretty significant. So how do you kind of weigh where we're heading with that big of a question mark?
So I think the way we look at it is, clearly the administration wants to do tariffs. They believe it's raising revenue. This is something that Trump has talked about for many, many years, about something that he legitimately believes in. Do I think he really wants to tank the economy? No. So they'll probably end up somewhere in between, and that's how we'll end up in this sort of 80 basis point headwind, which is kind of similar to the negotiation that we started with China last time, is they ended up doing tariffs on roughly half of the goods.
What gives you that confidence that the administration is not aiming to tank the economy right now?
Well, of course, it's hard to have confidence in with this administration who's particularly uncertain. I don't think that necessarily achieves exactly their goal, right? They want to do tariffs. They want to raise revenue. They don't necessarily need to tank the economy entirely to do so. They can achieve their goals in a way that would result in a slightly slower growth, an adjustment type of period, but one that doesn't necessarily result in a very high unemployment rate. So we can achieve all of those things that could get the Fed to cut a little bit more than would otherwise be the case, bring down 10-year yields, and realistically, at the end of the day, we're sitting here in an economy that's slower than where we were, yields are a little bit lower, and you kind of get to the same place without having to have a real painful recession.
While the administration hasn't used the words tank the economy, they have used the words there might be some near-term or some interim pain. And so if we were to quantify what that pain could look like, if we're kind of analyzing a range of outcomes and scenarios here, what is the best case scenario versus the worst case scenario from how you're modeling as well?
Best case scenario, you have a 20 basis point headwind to growth. And then the worst case scenario is you have a 2 percentage point headwind on growth. So the way I think about it is if growth was going to otherwise be 2.2%, the best case scenario is we end up with a 2% GDP growth this year, which is kind of trend. 2.2% was our, all else equal before Trump and tariffs. That would have been our GDP forecast before the case. And then if you have a 2 percentage point headwind on growth, now we're talking near recession type of backdrop. So that's the range of outcomes. Base case is generally somewhere in the middle. So you're at that 1.6% GDP, which is just a little bit below trend.
And at what point does this question about the soft data start to impact consumer spending and actual activity that we might get more clarity on in more of that hard data moving forward?
So soft data have historically, especially in the past couple of years, have not predicted hard data. So there are times where there are big discrepancies where consumers feel bad, yet they're still spending.
Right.
That was largely related to the inflation that we saw the past couple of years. Consumers felt really bad about the inflation, but they actually had the means and the ability and desire to spend. So it's possible we'll see soft data and the consumer will still be okay. We're starting to see some signs that the consumer is slowing down a little bit. So I would anticipate to see consumer spending also growing at with a one handle somewhere around 1.5%. But the soft data will be an important indication, at least directionally, how the consumers are feeling. So today's data will be important to gauge as the headlines just continue to mount, how are consumers directionally feeling about the backdrop?
And I guess for the Fed, it's how much of that data, and if it does come in softer than expected, how much of that data actually makes a trend that prompts them to make a policy move one way or the other.
Yeah, and for the Fed, when we're thinking about the soft data, the most important thing is going to be inflation expectations.
Yeah.
They care how consumers feel about inflation in the next couple of years, because that's going to be the deciding factor about whether they can actually feel comfortable about cutting interest rates in response to weak growth. Last time they were able to do that. This time they're going to have to watch that. If inflation expectations remain anchored, the Fed is going to be able to be a little bit more accommodative.
30 seconds. What's your favorite economic indicator right now?
Probably claims.
Okay.
Come out weekly, watching them both from government layoff. Claims are reported separately, so watch those separately from the other claims to get a sense, is there some other fallout as a result. As of now, they both kind of look okay. Government claims have risen, about 1,000. We're talking initial claims here, about 1,000 above what they normally are. It tells us that DOGE layoffs haven't really happened in a big way yet. And we'll be watching that to sort of gauge whether there is more fallout as a result.
Yeah. Stephanie, great to catch up with you. Thanks so much for joining us in studio this morning.
Thanks for having me.
Absolutely. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, KB Homes drops after earnings. We break down the picture for the housing market. That's next. Plus, Tesla sees a sales plunge in Europe. We'll break down what that means for the car company and one investor, why they remain bullish. All that much more on Morning Brief. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, shares of KB Home are sinking pre-market after posting lower than expected sales in the first quarter and cutting its outlook. Ahead of those disappointing results, our next guest lowered his price target on KB Homes to $67 and maintained his neutral rating on concerns about the company's weaker orders. I want to bring in Rafe Jadrosich, who is the Bank of America Securities Senior Equity Analyst. Rafe, good to have you here with us this morning. Just take us into your analysis on KB Homes and what it signals about the broader housing market and build-outs right now.
Hi, good morning. Thanks for having me. Yeah, I think it was a really challenging first quarter for KB Home in the broader housing market. We also had Lennar report last week, and in general, home buyer demand remains soft. We still have elevated mortgage rate, consumer confidence is weak. Builders have had to come out and adjust some net price. In some cases, it's with higher incentives, mortgage rate buy downs. In the case of KB Homes, they actually reduced some base prices in about 50% of their communities. they lowered price by about $15,000 per home. So we're seeing a soft market right now that's impacting both orders and margins.
Yeah, and they also talked about the soft spring that they are experiencing, to your point, Rafe. Is that a sign of things to come in the housing market?
It's been really consistent across builders that have reported so far. They are not seeing the typical seasonal uptick that you would anticipate at the beginning of spring selling. We do think some of this is concentrated by certain markets. So the Southeast right now is weaker than the rest of the country. Particularly if you look at Florida and Texas, where there's some elevated inventory, but we've generally not seen a normal seasonal uptick that you would anticipate in spring.
And so, as they're forecasting some of these margin declines in 2025, how is that also going to see some pressure both on the materials and the labor side, which we know are two of the major kind of shifting considerations or larger headwinds at this juncture for the home builders?
So builders, in addition to kind of the soft demand environment that we've seen, builders actually are facing a pretty inflationary environment. The biggest headwind is actually coming from the land side. So land that they contracted over the last few years that they're delivering homes on today have quite a bit of inflation. In some cases, it's even double-digit percent. So that's a big headwind. On the material side, I think the big risk there is some of the tariff pressure. And the one we would call out would be lumber. About a third of lumber in the U.S. comes from Canada. Obviously, there's been proposal for a 25% tariff there. So that's the biggest material pressure. So far on the labor side, there has not been disruption. Seasonally, it's not a big time for building at the beginning of the year. So it's definitely something builders are concerned about, but they haven't seen. But we are seeing some material and land pressure on the builders' margins.
When you mention the inflationary land component of this, it kind of naturally takes the mind to what the Trump administration has talked about to a certain extent of wanting to look across some of the public lands and try to figure out where there can be a rezoning or deregulation. Is that something that would be net positive for the home builders, or would it just be something where investors would also have to think about how much money would be going out the door in the near term to purchase some of those lands to eventually build on as well?
Yeah, it's a great question. So opening federal land for residential development, there are a few markets where that could possibly be a tailwind, where you have a shortage of lots. So an example would be sort of in the Las Vegas market. There's lots of land that could be open for development. One of the challenges, though, is these are local markets, and a lot of the restrictions you see on zoning are handled at the municipality level, and there's not much from a federal government level that they can do to open up a lot of these. So it really comes down to the municipality, and housing is just a local business.
So talk to me then about how the Federal Reserve impacts these home builders. We have Raphael Bostic calling for one rate cut this year instead of two. To what extent could that be a headwind?
So definitely elevated mortgage rates have added to some of the caution for home buyers that we've seen at the beginning of this year. But we've had a high mortgage rate environment now for a couple of years. So this isn't something new that's to home buyers. I think part of the challenge is rate volatility. When mortgage rates are bouncing around, you see home buyers sometimes pause and step back to see where everything is going to settle in. But obviously, you have an affordability headwind that's out there for entry-level buyers. So lower rates help that. But just getting some stability tends to increase confidence.
All right, Rafe, thank you so much. Really appreciate it.
Great. Thanks for having me.
Next up, shares of nuclear power startup Oaklo falling in pre-market trading after the company reported it expects significant expenses and continuing financial losses going forward. Oaklo paring back the double-digit gains that followed its announcement on Monday that it's made progress on its application with the U.S. Nuclear Regulatory Commission, and days after signing that agreement with the Idaho National Lab to find a site for its first powerhouse. You can see those shares down about 5%. A lot going on with Oaklo here. One thing to point out straight away is that the company does not have any revenue. So that is the first thing here, no revenue. However, when you look at the share price, if we can pull up a chart showing the past couple of days here, you can see there was just a big turnaround in the stock off that news I just mentioned, the potential partnership with the Nuclear Regulatory Commission. You can see that huge pop on Monday, and then boom, coming out with earnings, a big surprise to the downside, and you've got that leading to a little bit of the sell-off in these Oaklo shares, which is really interesting given that run-up that we had just seen off the back of that announcement. But I think the company fundamentals here when it comes to the revenue story weighing on the stock.
Yeah, and when you're not generating revenue, a lot of the investors and analysts of any coverage that's out there are going to focus in on how much you're looking to spend. And here's some numbers for you in the outlook and guidance. Oaklo is expecting and projecting cash use in operations for the full year 2025 to be in between $65 million and $80 million here. And so that's money going out the door and being put as investments into projects that will eventually get them revenue generating and profitable. They had an actual EPS in this most recent quarter of a loss of about 7 cents. That was compared to the forecast that was of about six and change cents. All those things considered, this is still a long kind of runway that we're looking at for Oaklo to be a extremely profitable company to the point where it passes through and pays dividends to shareholders at the end of the day. And it's going to come back to these reactor designs that you mentioned too. Powerhouse reactor design, that's been expanded to 75 megawatts. The scientists out there can chime in on Twitter after we post this clip and let us know exactly how significant that is. But the other thing too was the acquisition here. Atomic Alchemy, they completed that acquisition and that essentially enters them into the radioisotope market. So we've exhausted at least most of my 11th grade science knowledge.
Well, it's important because it is this nuclear play, but I think a lot of investors who might be getting into these nuclear names, they saw the run-up in utilities, they saw the run-up in nuclear, and they got invested. And then you have a company like this where you still have to make sure you're having your good investor hygiene, looking at the fundamentals moving forward here.
Yeah, I did take science in college too.
Nice. So, there you go. I was a Roxford jock.
Never sell yourself short.
Exactly. Never sell yourself short. All right. Well, finally, actually, I'm sorry, Brad, you take this one.
It's all good. I mean, look, shares of DJT, let's check in on them. DJT, which owns President Trump's social media site True Social, are on the rise after the news. The company will partner with Crypto.com to launch a series of ETFs through its fintech arm. The non-binding partnership will include Bitcoin, Kronos, and other cryptocurrencies that with what it calls a Made in America focus. Shares of DJT here, they are up by about 9% on the day. And you had actually seen another announcement that just came across from the Trumposphere, if you will.
That's exactly right, Brad. Taking a look here at DJT. And by the way, I was distracted when we started this segment because I was trying to take a look at any analyst recommendations for DJT, and there are none because there are not analysts covering the stock necessarily at this time. It typically trades off vibes and less off fundamentals. But some other news in the Trump sphere here. Donald Trump's World Liberty Financial crypto venture saying it will launch a dollar-pegged stablecoin this morning here. World Liberty Financial saying its USD1 stablecoin will be backed by U.S. Treasuries, dollar deposits, and cash equivalents. Brad, I know this is something that has been coming up in your coverage for a long time here. This plan, again, being 100% backed by short-term U.S. government treasuries, government dollar deposits, cash equivalents. USD tokens will be minted on Ethereum and Binance Smart Chain blockchains as well.
Yeah, I can only tell you what they've continued to, in the thread and the string of how they've been publicizing what World Liberty Financial's initiatives and goals are, looking to try and further pioneer their words in the DeFi space and really trying to democratize even more access to financial opportunities, but safeguarding the global standing of the US dollar here. So all of these things considered, especially as you have a stablecoin mindset, it's essentially saying, okay, $1 in, then you get one stablecoin. It's directly pegged. It would probably get a lot more flack if it was an algorithmic stablecoin. Thank goodness we've moved past much of those efforts, but all the things that we've looked across most recently coming out of World Liberty Financial, the week after the election even, they were talking about this new partnership with Chainlink and trying to make sure that that actually leverages the Chainlink platform in order to kind of add more securitization to the lending protocols that take place within the crypto landscape as well here. So that's just the latest out of the World Liberty Financial side of all of the kind of Trump businesses that are floating around.
A lot of names to mention there. Obviously, what you just mentioned with World Liberty Financial, but also TruthFi, which is the fintech platform under Trump Media, which is backed by Charles Schwab, we should mention. And also, you can see here, obviously, partnering with Crypto.com. So a lot of names there. All right, we're going to have all your markets action ahead on Yahoo Finance, so stick around for more. We are just seconds away from that opening bell. You can hear that ringing on Wall Street here. You're looking at the NYSE and the NASDAQ. But let's do a check on our markets this morning because good news, we've got more green on our screens, at least for now, to report. I'm taking a look at futures right now as I'm giving our screens just a second to react to the market open here. But as you can see, still looking at gains here. You've got your S&P 500 up just about 0.1%. I'm going to wait for my NASDAQ to dial in here because I doubt that we are up 2% already this morning, but you've also got your Dow Jones Industrial Average moving to the upside. It's going to be interesting to see if those moves continue. We will eke out our third straight day of gains in the market here following a slew of sell-offs that we had seen off the back of a lot of uncertainty in the market. You've got an unwind of momentum. You've also got that tariff uncertainty. Just want to take a look at how our big tech names are doing this morning. Fascinated by the move that we are seeing in Tesla here, moving to the upside. It's one of the only companies I can think of that gets news about a 40% sales plunge, and the stock is still moving to the upside. No thanks there to Cathie Wood, who said that she is still bullish on the stock. Taking a look at the rest of our Mag 7, though, you've got more green than we've gotten used to lately for these 7 stocks here. You've got Apple just below the flat line, hovering a bit. Nvidia, the only one really staying in the red here this morning, down just about 0.8% here. And lastly, I'll do a little global look for us to see how we're doing when it comes to the global trade here. Interesting to see China moving down to the downside. You've still got Europe moving to the upside off the back of that European exceptionalism, end of U.S. exceptionalism, though we have seen more analysts this week saying that the U.S. exceptionalism trade is still intact. And as you can see, you've still got your major averages in the U.S. moving to the upside this morning. Let's get it over to Jared Blickery for a broader look at what's moving. Hey, Jared.
Thank you, Maddie. I want to go back to the S&P 500. I will put a year-to-date chart on here, and I just want to highlight, yesterday was a very productive day. Reclaimed, this is the S&P 500, reclaimed a key technical level, that is the 200-day moving average, but just above that lies the January lows, and there's actually a few different reasons why that's a more important level, and we just haven't quite cleared that, so there's a little bit of work to do. Another thing I didn't quite like about the rally yesterday, it was on lower volume, and you don't want to see that on a big breakout. We did have nice participation, and in fact, it was the best day for small caps. This is Russell 2000 and the Mag 7, by the way, since the election. So we definitely got some things done, but it's not convincing me just yet. Now I want to go to the 10-year T-note yield. That briefly touched the highest level in about a month here. And what's interesting, I like to look at the T-note yield and then the dollar. Those have been moving in opposite directions recently, basically since the February sell-off. And in that time, we just had this kind of different macro play and different forces at work that require a different playbook. That is still ongoing. So that maybe tells me that there's still some things for this rally to prove if we're going to get back to the prior leadership in the bull market. Now let's take a look at some of the sector action one more time. Maddie was just taking a look at that, but I want to make sure, there we go. Energy still in the lead, that's up 1%. Real estate, utilities, and staples, 3 very defensive sectors in the red. So this is a bullish setup for the day. And now let's talk a little bit about the Mag 7. We got Amazon and Tesla coming off the best day since the election. And the Tesla and the Mag 7 ETF MAGs are both approaching their 200-day moving average. Here is a year to date, and the 200-day for Tesla just right up there, just within spitting distance. We'll have to see if Tesla can cross that boundary, but you can still see it is down 31% year to date. And Meta, let's take a look at Meta. And we haven't seen a 20-day winning streak in a while. There it is. But Meta bouncing off of its recent lows here. That was its best day in 2 months loss yesterday. So a lot of things, as I guess the theme here is, we got some work done yesterday, but some more to prove. Copper, want to take a look at copper. Almost every day I've had this headline, we are nearing a record, we're nearing a record. It's just been inching closer to a record high, but we're looking for those highs that we saw back in May, and it looks like we're almost there. On an intraday basis, we are not quite there. You don't see that in the picture, but suffice to say, copper at a record, and then I will close on Bitcoin. Let's take a look at crypto prices. Bitcoin coming off a 2-week high. That's a 2-year chart. I want to show you the 5-day. 2-week high, but really seems like we got a ways to go here when you take a look at that 1-year chart and we see those highs up there. I'll leave it at that and send it back to you, Brad.
Jared, thanks so much. Teeing up today's market activity. Appreciate it. It's time now for today's strategy session. Technical indicators beginning to show bullish support for the S&P 500. Monday's risk-on rally pushed the benchmark index above its 200 and 20-day moving averages, a bullish trend for the beaten-down average. Joining us now, we've got Larry Tantarelli, who is the Blue Chip Daily Trend Report Chief Technical Strategist. Larry, great to have you here in studio with us this morning. Last time you joined us in January, you accurately called for a 10% pullback in stocks. What do you believe the technicals are showing is next for the market?
So the technicals are improving, but you're right, we did get that 10% pullback. It happened a little bit faster than I expected it to. I think the tariff headlines really accelerated it, but we're in a recovery phase right now. So we went from 6140 to about 5,500, so a 600-point drop. We're right back up to about 5,800 or so, so we've retraced 50% of that move. Mm-hmm. So from here, I think it's really based on the headlines.
And talk to me about that. If we do get tariff certainty, does that equal gains in the market necessarily?
I think it should take some pressure off the market. I think the biggest concerns in the markets have been not only tariffs, but the uncertainty. Does the economy slow? Do companies cut back on hiring? Things like that. So I think if we get some clarity on the tariff picture, the market sees that as a positive sign, and I think we do move higher from there.
What if that uncertainty, I mean, it's appearing to be a feature, not a bug for this administration. That uncertainty is going to be here for the next 4 years. So then yes. How do we think about where the market's heading in that environment?
I think for the time being, we need to still expect higher volatility. So the markets are still very headline driven. We saw bullish tariff headlines yesterday, or I wouldn't say bullish, but maybe a little bit more dovish. The markets like that quite a bit. Tomorrow we could get a headline that the markets don't like, and then everything goes back down 1 or 2%. So I think we really need to expect headline-driven volatility, at least through April 2nd, maybe more.
I think last time we had you on, your S&P 500 target for 2025 was 6550. Mm-hmm. Still in that ballpark?
Yes.
Yeah?
Yeah.
What do you think gets us there?
I think two things. I think bullish seasonality. I think as we get to the second half of the year, we'll see more bullish seasonality. And that would be really the key thing. I think that earnings estimates will continue to hold up, and then I expect the market to resume higher. But the one thing that we do have to keep in mind, there is some risk if the economy slows down. There have been some signs that the economy might slow, some signs that the consumer might slow, so we always have to keep that risk in the back of our minds.
So given that risk, where do you diversify? Do you look Europe, China? Do you hoard cash like Warren Buffett? What's the great diversifier of the moment?
I think the diversifier right now is diversification. So what I mean by that is I have a little bit more Europe exposure right now than I usually have. Mm-hmm. I've got a little bit more China exposure. I've got a little bit more cash. But I still have tech. I've got my growth stocks. I've got my core S&P 500 names. But I think until we get some clarity on where the rotational moves are going to be, I think it makes sense to have no all-in sector bets. Have some Europe, have some China, have a lot of the US, have a little extra cash, and then maybe once we get some clarity, if we get some definiteness on tariffs, and then the markets start to get into a trend, then I would focus on those trends. But for right now, I really think we need to spread out the allocation.
Just lastly, while we have you here, as we're thinking about the tech trade more broadly here, it was some of the biggest names in the Mag 7 that had actually started to lead the declines early year to date, thinking about NVIDIA, thinking about Apple, and then we got the sell-off on top of that.
Right.
What is your outlook as you're thinking through where the Mag 7 still has legs to outperform versus where it just might keep pace with the rest of the 493?
The Mag 7's not my favorite, so I think it's going to be a market performer. I see stronger charts in cybersecurity, stocks like Palantir, stocks in communication services like Spotify and Netflix. So what I always want to do is I always want to focus on the strongest stocks in the strongest sectors, but I'm seeing more opportunity lower down the market cap phase than in the mega caps. I think the mega caps are going to be market performers.
And thank you for giving us your picks there too. I heard Spotify, I heard a couple of names to our audience to keep in mind on, so thank you so much, Larry.
Sure.
Appreciate it.
Thank you so much for having me on.
Turning now to some sad news in the world of electronics. Samsung co-CEO Han Jong-yi, who is credited for growing the Korean conglomerate into the world's top electronics company, has died. In a statement from the company, Samsung announced its co-CEO suffered a cardiac arrest episode which led to his death. He was a company veteran who began his career in the displays division more than 3 decades ago and was instrumental in displacing rivals such as Sony. After being promoted to vice chairman in 2021, he led the so-called device experience division, overseeing Samsung's TV home appliances and smartphone businesses. Most recently, he took charge of efforts to integrate AI into most of Samsung's products in anticipation of the boom in artificial intelligence features for everyday use. Under his leadership, the company has installed AI chips in its fridges, washing machines, and vacuum cleaners. He's survived by his wife and 3 children. He was 63 years old. Our thoughts with the family. We're going to have more coverage after the break.
Tesla paring back earlier gains, coming off its best day since the election. The EV maker still off its highs, though, down over 30% so far this year. Shares are actually lower right now to begin today's trading activity, down by about 1% in early innings. Still, ARK Invest's Cathie Wood sees further upside from here. Wood saying in an interview on Bloomberg TV the stock will hit $2,600 in 5 years, with 90% of the growth coming from, get this, robotaxis. And if you think further into how they've been evaluating the robotaxi TAM, that total addressable market, and how Tesla compares to some of the others out there, specifically Waymo, according to their research, Waymo's commercial robotaxi service is logging about 200,000 miles per day. Impressive metric, they say, given its small fleet size. All that said, though, they still believe that it's going to prove, their words, inferior to Tesla's full self-driving service, which even before the planned launch of its robotaxi service in June is logging about 10 million miles per day across a myriad of real-world conditions, as they have kind of modeled and published, I should say.
I think it's important to note that later in this interview with Cathie Wood, she did talk about her investment thesis overall and that younger people who can afford it should take more risk because this is a risky call. Having said that, historically, Tesla stock does tend to go up. You can see right now shares reversing their earlier gains, perhaps off the back of news that the company's sales in Europe plunged another 40% here. She did say that if you look at metrics like range and power for a given price, Tesla is extremely competitive, if not the most competitive, depending on the model. She said Tesla and BYD are both in the lead from an EV point of view alone. If you layer in robotaxi, of course, BYD is not seizing the moment there. So throwing a little bit of cold water on the idea of BYD as the big competitor to Tesla here, and also just talking about the fact that she sees, to your point, Brad, the robotaxis accounting for 90% of the company's value moving forward. What I'm excited to get clarity on is whether or not any damage to the brand can be withstood by the existence of those robotaxis.
Yeah, absolutely.
All right, Tesla sales in the EU remaining under pressure, sales plunging 47% in February, despite a surge in overall EV sales in the region, according to the European Automobile Manufacturers Association. Meanwhile, here in the U.S., the FBI launching a task force amid bomb threats at a Tesla dealership in Austin, Texas. Anti-Tesla sentiment and settlement growing as CEO Elon Musk asserts his political influence in the U.S. as well as Germany. All of this coming amid a brewing trade war that puts autos in the crosshairs. Joining us now, Tom Narayan, a global autos analyst over at RBC Capital Markets. Tom, great to have you here. Talk to me about how you are viewing Tesla. We'd previously had you on before you lowered your price target. You lowered your price target recently, but I believe that you are still bullish overall. Why?
Yeah, I mean, our price target revision had more to do with some long-term views that we had on robotaxi and FSD. I think we were a little too aggressive at a $440 price target. We pulled back based on some market penetration analysis we did. So now we think China and Europe for robotaxis will be 10% Tesla penetrating instead of 20%. And for FSD, we had modeled in $100 per month pricing. We think that comes down. There's a lot of other companies now offering similar autonomy products, and we think that pricing will come down. Now we're using $50 per month. So it does bring the price target down quite a bit from 440 to 320. But still, based on where the stock is trading today, you're right. We do see some upside.
Is there deterioration that you're seeing in the mind share that Tesla is trying to both grow and retain in some of the international markets that are seeing some fierce competition start to arise and attract and get their own market share as well?
Yeah, but I do think this was somewhat expected. There's more competition, obviously, in China, obviously, with domestics there, especially in that middle market segment. And then Europe, there was always going to be increasing competition there. So, let's not forget Tesla is half of the entire US EV market today. Through January and February, the data in the US, actually Tesla was up. They do have two new models, the Model Y refresh, the new affordable car coming, which could potentially help stem some of these losses. But you're absolutely right. There's increasing competition in Europe and China. But remember, EVs is still relatively underpenetrated globally. So it could be a rising tide lifts all boats when it comes to car sales.
But I guess the thing that makes Tesla different is that all of those other car companies, correct me if I'm wrong, don't have as polarizing a figure that sits at the top and essentially is the face of a brand.
Well, I mean, yeah, you're probably alluding to what's being said in the press about whether or not car sales are being impacted by this. But I would just note, like, if this was any other car company, and I'm just looking at the data, which is what I do for a living, and I look at the January data and the February data, what I noticed is, first of all, those 2 months are not really big months for car sales. Also, this company had an intentional production cut in anticipation for the Model Y refresh. They also have a brand new model coming in at a very low price point. So it's entirely possible that consumers were waiting on these. So if this was any other car company, I would think, okay, it's soft data, especially relative to the market, but it could have been due to these other conditions. The other thing I would add, and I've been hearing this from investors, is that, while it's very easy to, let's say, boycott a soda brand in the grocery store, difficult to do that with a car purchase. People usually buy a car purchase. It's what's best for their families. Big ticket item, like I said, half the market in the US for EVs. People like the range versus price dynamic. So, the devil's in the details. We've only had 2 months in of data so far. We need to see how these new cars do when it comes to demand. Are the people who are protesting the same ones buying the cars, right? So let's see what happens.
It's a great point, Tom. But what I'm fascinated by, to your point, is the data showing those plunging sales, which, to your point, is not necessarily something that's indicative of a boycott in your view. But we've spoken with several people over at Kelley Blue Book, at other used car companies, who have said that there has been an increase in people selling their Teslas specifically. You've got not only the political headwinds, but now a serious safety risk for people who are in these Teslas. What are you going to look at to determine whether or not that noise turns into a long-term branding problem for Tesla that could significantly lead to a risk for this company?
Yeah, we have to see how these two new models do. The Model Y refresh, which is it is a significant upgrade for that vehicle. Also, this affordable car, which has been talked about a lot. Let's see how that does, right? I mean, it's a $30,000 car, including the IRA credit, which is still there, right? So let's see how these vehicles do in the coming months. That could stem some of these thoughts. The other thing I would say is, we look at plunging sales, right? That's the word we hear, on a growth rate level. But when you look at the absolute number in Europe, for example, which is often cited, down 45, down 50%, let's remember that these are small numbers off of small numbers, right? The company sold 1.7 million cars last year. These are we're talking about 18,000, 7,000. So intentionally shutting down production could easily account for these thousands of cars. And so let's see how these new cars do.
Tom, I only got about 15 seconds here. The impact of tariffs on Tesla, what are you modeling around that?
Yeah, so we're actually consistent with what I think investors are saying. We don't have Canada and Mexico. Could have some reciprocal tariffs, some on China, but really, honestly, not a ton of impact. Remember, car sales is only like 10% of our valuation. Most of it is robotaxi and FSD, so not a ton of impact.
All right, interesting. Tom, thanks so much for taking the time here with us this morning.
Sure. You got it.
All your markets action ahead. Stay tuned. You're watching Morning Brief. The chairman of Alibaba is issuing a warning about a potential bubble forming in the data center construction, saying the pace of these build-outs may surpass initial demand for AI. Here to dive in, we've got Yahoo Finance's tech editor, Dan Howley. Dan, what do we know so far on this?
Yeah, basically, this is kind of on fears that there's more build-out than necessary when it comes to these kinds of data centers. So the idea being that, look, we have all these people going out, buying up the NVIDIA chips, buying up the SK Hynix memory, and putting together these data centers, billions, tens of billions of dollars being laid out by all these tech companies. And then we have the CEO of Alibaba basically saying, do we need them yet? Because there's not really too many practical use cases on a consumer level. And then on an enterprise level, they're rolling out, but is this kind of putting the cart before the horse? Now, the other flip side of thinking when it comes to that is, well, if we do start to see a huge uptick in usage and we don't have the capabilities laid out, well, then we're just going to be missing out on revenue. And so we have Microsoft previously, Google previously, I believe Amazon as well, saying, look, we want to be able to generate more revenue from AI, but we're constrained right now just because we don't have the capacity to reach demand. And so there's kind of two sides to this. It's some of these hyperscalers, US hyperscalers are constrained when it comes to their own offerings. They don't have the chips that they need or they continue to build out. And then there's this, are they building out too much too quickly, putting out too much cash? When do we start to see kind of the whole revenue come back? And that's kind of been the discussion ever since this all kind of exploded in 2023, really.
Yeah, we got about a minute left here, Dan. I'm just curious, my kind of journalist spidey senses, I want you to correct me if I'm wrong here, but I was just curious about like what's in it for Joe Tsai to have this take. Why is he suddenly throwing cold water on the AI data center build out?
They're a company that's trying to also get into, the AI space. They're obviously in it already, but, it would behoove someone. I mean, they're not exactly laying out billions and billions of dollars that Microsoft is, that Amazon is, that Google is. It's $100-something billion plus dollars that these companies are putting out next year, whereas Alibaba's laying out tens of billions across 3 years. So it's a smaller amount. It could just be that they're hedging and they don't want people to think that they're going to be left behind, that they're aware of what they're doing, or it could just be that he genuinely thinks that this is a potential bubble. Now, that's been a discussion for months, right? I mean, a year, right? More than a year at this point. But the tech companies keep on spending, and they clearly see something going on. As I said, on the consumer side, not so much the enterprise side. There's definitely an uptick.
Yeah. All right, Dan, thank you so much for joining us and breaking that down. Really appreciate it. That's going to do it for the morning brief this morning. Join me for the next hour for more analysis right here on Catalyst, and you'll have Brad at 11 a.m. Eastern for more on wealth.